Well, the S&P 500 doing something rather unusual on Tuesday. It spent the entire day above the highest level it hit on Monday. It's the second straight session it has done that. It has only done that in 4 prior 2-session periods, going all the way back to 1980. Welcome back to Trading Nation. I'm Brian Sullivan, Rich Ross with Evercore ISI, Max Wolff with 55 Capital. Rich, we're speaking your language here, buddy. I mean, sort of obscure references to technical points and 2 back-to-back periods above the entire period of the previous day. Why is that so rare, and what does it mean?
Yeah, Brian, those windows that you're referring to, that sort of leap higher on 2 consecutive days, we call that, as I mentioned, a window or a gap higher. Why is it so difficult, Brian? Because think about how big the S&P 500 is. That's a lot of market cap to really leap higher. This is like the Shark Week video of the great white leaping out of the ocean. That's what it takes to get the S&P to open higher, that much higher on 2 consecutive days without even touching the prior day's range. It's very bullish. It speaks to that element of surprise and to the urgency of investors to get back into a trend that perhaps they had stepped out of as the reflationary rhetoric had been called into question going into the French elections. So it's just a continuation pattern to the upside as we work out of that very bullish counter trend flag. I think there's another 100 points of upside. Now it's about 80 points of upside to 2470 by the end of the first half before volatility picks up. But once again, Brian, it speaks to the urgency for people to get involved with this trend that's been unlocked by the French elections, and I think there's meaningful short-term upside here as we get a little bit of a buying panic that builds into exhaustion.
Okay, but Max Wolff, I hear Rich's points. I'm not going to ask you to comment on technicals unless you really want to, but when I hear buying panic, I start to panic a little bit.
Yeah, sure. There's always a certain amount of danger in a melt up. That being said, people are trying to get out of all kinds of other things, and there's not too many places to go, and this is a place to go. So particularly the indexes are going to be very strong because the indexes tend to be market cap weighted, and people are rotating to the biggest names in the most secure markets from all kinds of other markets. I mean, if you look at the bond performance, that's been telling a kind of different story, so there's no market consensus here. There's still enough nerves out there that people are pushing up the 10-year U.S. Treasury, and we're not seeing all the markets around the world, particularly some of the bigger names, the emerging markets, kind of be part of this, so we know the money is going certain places. This is one of those places, so we do see more momentum up on the S&P. The problem here is that this is a sentiment-driven reflation expectation. Could be true, should be true on some level given what we've heard, but it hasn't come true yet, and so that kind of incrementally introduces extra risk as it moves higher. So we do want people to be conscious of that incremental risk increase, but does look set to go higher from here.
Okay, guys, a really interesting stat there. We appreciate you rolling with it so easily. Thank you. Appreciate it, Max and Rich Ross. And folks, we always appreciate you. Thanks for tuning in. I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.